Are we experiencing the irrational exuberance now? Massive layoff is everywhere, but the stock market is uptrended. Are we expecting a financial crash very soon? Irrational exuberance is a term that describes a state of mania or overconfidence in the stock market, when investors ignore the fundamental value of assets and expect prices to keep rising indefinitely. It is often associated with stock market bubbles and crashes, such as the Wall Street crash of 1929 and the dot-com bubble of the 2000s. A stock market crash can cause a recession by reducing business financing and consumer confidence, both of which can affect economic activity and demand. However, a stock market crash does not necessarily lead to a recession, as there may be other factors that mitigate or offset its impact, such as monetary and fiscal policies, global trade, technological innovation, etc. Whether we are experiencing irrational exuberance now and whether we are expecting a financial crash very soon are difficult questions to answer, as they depend on many variables and uncertainties. Some possible indicators of irrational exuberance are high price-to-earnings ratios, which measure how much investors are willing to pay for a dollar of earnings. High market capitalization to GDP ratios, which measure how large the stock market is relative to the economy. High margin debt, which measures how much investors are borrowing to buy stocks. High volatility, which measures how much stock prices fluctuate. High speculation, which measures how much investors are betting on future price movements. Some possible triggers of a financial crash are external shocks, such as natural disasters, wars, pandemics, etc. Policy mistakes, such as raising interest rates too fast, tightening fiscal spending too much, etc. Financial contagion, such as the spread of defaults, bankruptcies, or crises across markets or countries. Behavioral factors, such as panic, herd mentality, or loss aversion. Ultimately, the stock market is influenced by both rational and irrational forces, and it is impossible to predict its future with certainty. Therefore, investors should be cautious and prudent, and diversify their portfolios and risks.